Start ಮಾಡಿ.
Yes, sir. Good evening, everyone. So we are continuing our web series on how to make doctors entrepreneurs and how to make an existing hospital run in better, more, bringing in the quality. Plus, how to associate with people who are good in the field, who can help us and who can enhance the outcome of the hospital. So the rebuild concept, we are continuing the web series now. So today we have extremely good speakers, Mr. Srikanth, Srinivasan, Mrs. Radhika Bali, and Sir. So we have panelists. Today's session will be moderated by Dr. Prakash Pengal, sir. We have other panelists of Nalanda and other panelists you have today. So I request Kishore Kumar sir and President of NNF Karnataka State Chapter to give a brief introduction about great eminent speakers what we have today. And then I request Prakash Pengal sir to moderate the session. Sir, Kishore sir. Before that, I request our President of NNF Karnataka State Chapter, Kotreshi sir, to quickly say a few words, and then Kishore sir will introduce all the eminent speakers today. Kotreshi sir.
Kotresh.
Hello.
Good.
Hello. Can you hear?
Yeah, we can hear.
Can you hear? So I am proud to say President of Karnataka NNF because apart from the academic activities, we are doing the so much of inputs on how to stabilize, how to give increased infrastructure, how to go with the legal farm, how to go with the social levels, how to go with the taxation level also. Today, you have taken the legal problem by Joga Rao and importance of taxation by Srikanth Srinivasan and hospital account management because most of the times we are very poor in hospital management accounts. We'll be mainly concentrating on clinical experts. So there should be updated daily. So through this we can get a lot of messages. Most of the times, even if you meet CA, will not be able to understand the situation or lack of time will not be able to go also. So okay, Karnataka NF are doing the wonderful job. And with our Vice President Dr. Kishore Kumar, our Secretary Dr. Prashant, and our President Dr. Radhika, with all the EVM members, we do the good activities on this ground. I welcome all the speakers for this participation.
Good evening, everyone. Welcome to NNFK webinar. We are learning about hospital management. Today we have a galaxy of. Sorry. Can you hear?
Oh, tell us.
Rajvi. Prashant, can you hear me?
I can hear you, Kishore. I think there are other people speaking in between.
Aman, can you mute everybody, please?
Kindly unmute and start the session.
Good evening, everybody. We are welcoming you to this NNFK webinar, where we are learning about various aspects of hospital management apart from medicine we have learned in the past. This is the most important topics in your life, without which you will not be able to manage the hospitals. And we have a galaxy of excellent speakers this evening. And I'm very, very proud to announce that Joga Rao is the professor of law of medicine. And unfortunately, he had a personal emergency in the last few hours, so he couldn't be here. But we are still with a lot of other excellent speakers. The next speaker is Srikanth Srinivasan. He is a chartered accountant by training and auditor by profession. He is enrolled as a fellow of Institute of Chartered Accountants in India in 2005 and is a founder member of the JCSS, a chartered accountant firm, and the founder director of JCSS Consulting Private Limited, a global consulting firm headquartered at Bangalore. He was associated with Bill Moria and erstwhile member of firm Ernst and Young, which all of us have heard over the last 6 years. Srikanth's move to independent career started in 2000 with setting up of JCSS, which clearly shows how many years experience he has got in this area. Over the years, JCSS has grown into advice industries across broad spectrum ranging from infrastructure to manufacturing to construction to information technology. And as a director, he oversees the audit, assurance, and corporate advisory function in JCSS. Through his career spanning 26 years, he has provided assurance and advisory services to various high-performing large and medium-sized multinational companies in India and abroad. He has directed and driven success of multiple audit and assurance engagements while ensuring the team develops a proactive approach in line with industry standards and ensuring high level of client satisfaction. Radhika Bali is a lawyer with too much of qualification and interest in medicine. She is a blogger, writer in medicine. She doesn't want me to expand her qualifications too much because she's humble and shy. And then we have Dr. Nikhil Datar, who is going to be our panelist this evening. Many of you have read his name in the media. He is one of the very few obstetricians in the country who is also a lawyer and has been employed as a professor or appointed as a professor in Law University in Mumbai. And he has been fighting for termination of abortion of affected fetuses between 20 and 24 weeks, because you know that beyond 20 weeks, it's currently illegal to abort. And he has been a fighter, and most of the times you see his name in the print media. We also have other panelists, Edmund Paul and others, whom we have already introduced in the past, along with Lakshman Kumar. And moderator today is Prakash Vemgal. He's a neonatologist and head of the Department of Neonatology in Rainbow Children's Hospital in Bannerghatta Road, Bangalore. He has an extensive experience, has worked in Australia and Canada in the past, and we are fortunate to have this galaxy of speakers. With this, our evening is full, and don't hesitate to ask any questions. We have intentionally kept the presentation very minimal so that you will have ample time to ask questions. And thank you all, and let us start without wasting much ado. Over to you, Srikanth.
Thank you, Dr. Shore, and thanks to the panelists, the moderator, and everybody else who has joined us today in the evening. I am hoping we will be able to have your ears and attention so that you're able to grasp something that is generally very boring for doctors, particularly. That's what I was telling before the program started. So briefly today, what we are going to cover is on the fund management, which is typically the most important aspect of any business, not only healthcare services, but any business today, because there is so much of shortage of money and there are too many people with a lot of ideas. So we definitely have a conflict there. So in making available the real money to the right people to grow. So there is always own money, or the monies borrowed from the institutions people invest. So fund management becomes highly critical for every organization, and it's a bloodstream to survival as well. With that basic note, and we are going to cover other aspects connected with this, which is very important, we feel, as part of it. So which is why Radhika and I are doing this as a joint effort rather than as an individual speakers, because we can keep your attention completely to the program so that we don't go wide talking as a solo. So we want to make this more like a duet program. So I hope you all enjoy. So over to you, Radhika, to give a brief introduction before we start the finance activity. Unmute, please.
Sorry. So, hello everybody. Good evening, and it is indeed a privilege to be here amongst great people in the industry. And we'll try to give you a bit of from our experience what we think is critical for the healthcare, upcoming, already existing healthcare institutes in the country. We are going to do this using a PowerPoint presentation. I'm going to share my screen and start with the slideshow. Just give me a minute, please. Is this visible?
Yes.
Yes, it's visible, Radhika.
Yeah, thank you. So we are essentially going to talk about hospital fund management, hospital financial management, call it as you like. Now, the first thing that we wanted to answer, and when we were asking ourselves, is that what is the differentiating factor when we are talking about the healthcare industry as such? And though I know that clinicians and doctors look at it as always realizing that it's a service, but it's a different service industry. We've, from a service provider perspective or from a support service perspective, we've divided as the three key factors that differentiate the healthcare industry today, right? The first key factor is that historically, healthcare is perceived or is at least expected to be perceived as it should not be run purely for profit. That is the first thing. So perception, acceptability, societal acceptability is very important here because it is to be perceived that it is purely not just for profit. The second is that it is a heavily regulated industry, and not just regulated. What the pandemic has told us that it is also ad hoc regulated. That suddenly you get up and you hear of the Disaster Management Act and so many notifications coming. There was a time when there were notifications coming every 3 days, which were affecting the health institutes, right? Which was the month of April and May. So not just heavily regulated, but very ad hoc regulated also. Okay. And the third thing is that your end customer is not necessarily always a happy customer. He is a needy customer. They need the service, but they're not necessarily happy. And may not, in a moving scenario, he may not always be the end payer of the service. With insurance, increasing its tentacles wider and deeper into the society, the receiver of service is not always the payer of service. Now, as we go through our presentation, we will partly explain why these three were the differentiating factors. But with this, I'd like to, explain that keep these three in mind as a differentiating factor, and then try and understand the entire presentation as we take this forward. There were two ways we could have presented this. We could have started by saying, ta-da-da, you have to have this, you have to have A, B, C, get a financial module, get a software, get all of this. Instead, what we thought was that with Srikanth's extensive experience, with my experience working with him and over the last decade in the healthcare industry, and we thought we will present to you a case study. The first, one of the most recent case studies that Srikanth has worked on. And we'll explain to you that how one particular healthcare institute in the country, with what is the positives and what are the negatives it has today in existence. I'm going to take you to the slide which shows you the basic facts of this. I will just tell you the basic character. Srikanth, do you want to explain the characteristics of the healthcare institute?
Sure, I can do that. Thank you, Radhika. So the case study was picked up with an objective that we understand finance or fund management, or its requirement for that matter, in a more deeper way, or at least appreciate the importance of managing funds right from the beginning, because often hospitals, especially in the healthcare units or any other business which is not directly connected with your education in finance, we've seen that it's all more of technocrats. Even we often come across startups which are in different industry, technology businesses, people with high level of techno knowledge, but they may not necessarily have the techno-economic knowledge of how to run an organization in a most judicious way that helps them to grow. In fact, many organizations, there are two categories of organizations. One is what we call it as build to own, and the other could be built to sell, right? So if in any case, whether you want to build to own it and continue to retain it forever for your generations to come and continue operating that, or if it is an objective that you are built to sell. In both these cases today, financial management or fund management becomes highly, highly critical. And there are so many wings associated with it, elements. It's like branches associated with the main tree. So let's take one case which I came across last year in the year 2019. I was approached by a healthcare client, and this is how their balance sheet looked to me. I just put it in different buckets. Later, this will be helpful to understand the components very essentially. This was a 120 bed plus bedded specialty hospital. They existed for about 10 years ago. It was started, and they were in around 10 years when I met them. So this is how the balance sheet looked like. They were operated like, I'll start from the top, where I'm saying it was organized as a not-for-profit entity type, which means they were in a more of a charitable, what do we call it as a charitable trust model, public charitable trust model. So typically a not-for-profit organization. And this is very typical of India. We have many hospitals, healthcare units, and this is quite special for healthcare, unlike the reason what Radhika gave in the opening statement, that most of the hospitals were looked up more for not for making profit. So they went into this shell, like education institutions and hospitals had a very typical style of operations, where many of them were set up as a not-for-profit organization. This was one such dreams, but I really went into the depth of it to see why they went into it. They probably did it more with the objective one. On one side, they wanted to portray as being more, friendly to the lesser of, income people, to a certain extent of social, obligations. And on the other side, they thought it's a no tax avenue. So that was one of the very attractive option, because today we have certain tax exemptions for such enterprises. So they chose that to be one of the methods. The second thing is, this hospital, when it was started, the specialist who started this comes from a very good, very wealthy family. So we had a lot of money. So the parents said, fine, we will invest all the money ourselves. We don't need to borrow. So they went and acquired land, building, constructed large multi-storied hospital structure, and they put up machines which were brand new, and all of that costed them almost about 80 crores. That was their investment. And then they went about spending money on operations. They were a debt-free enterprise. Of course, they were profitable, so they were debt-free, and they never had any borrowings through their lifetime. And so they never also cared about how this is going to be funded. So it was more like a reimbursement model for the hospital. Like whenever there was a shortage of funds, they could just go back and knocking the doors, and they would get some money, checks written down, and that's how they got funded. And they were operating on the basis of that. Then they also felt it was not so very critical to tie up with insurance companies or any of those. So whenever things happened, it happened. Otherwise, they were majorly, servicing only customers or patients who were settling bills on cash, and which means checks, cash, as the case may be, or credit cards, but not really the insurance type. Not that there was no insurance, but it was very minimal. In percentage terms, they were less than 20% of the total billings. Then came the capacity utilization. I looked at the one, to look at this hospital, I looked at the capacity utilization. They had a bed occupancy or inpatient occupancy of about 70%. And looked at it, it looked quite attractive. 70% was not a bad percentage in terms of performance. And they were also located in a prime central part of the city where they were operating from. So given this structure, it was one of the most beautiful dream to go to hospital, and I was interacting with the promoters, and they were quite happy with what they are doing, but they just were seeing that their business was not going upbeat, and I just looked at the enterprise value just to get an idea of what they are worth today. So they looked on the books of about 120 crores for a 120 plus bedded hospital. So that surprised me that while everything looks positive, no cash deficits, 80% of the revenues come from cash generation, from billings, no waiting time. Then you have prime location, good locality to attract a good customer base, 70% occupancy, and completely funded, in-sourced. So what was going wrong? I looked at the other side of the numbers. Probably I need help of Radhika to push me to the next click. Yeah, thank you, Radhika. So these are the key issues I found why they were still doing not so great. One, I will come to the inflexibility entity type to the last, though it's one of the very critical aspects of it. Let's start from below, though the presentation is the other way around. They had a falling margin of about 11. It was 11% about 4 years back, and it was coming down to 4% EBITDA. It was quite shocking, actually, because if I'm operating in such an environment, why am I at 4% EBITDA, which means my multiples are going to be terrible. Will I even be able to attract anybody to come and invest or to grow? What is my strategy to grow? So that became a very big concern. The return on investment was quite low because they were own capital. They did not realize that own capital also comes at a cost, which is very, very important and very significant point to remember in any business, and including services that we are in. And we are talking about healthcare, all the more reason, considering there are complexities to it, which I'll address. So looking at the operational issues, one of the key thing is there were poorly price points. Poor price points, what I mean by that was they never cared much about, they never had to pay any interest to anybody, or they never had to service a bank for their financing. So all the time they were like just not bothered about how to accumulate their cost correctly and identify the components of their costing. And that led to a lot of more than what is budgeted. Budgeting was ineffective because they did have budgets which kept, it was a rolling budget, so to speak. We never have a rolling budget in any business, but this one had, because they had to keep changing the budgets every quarter because they were not sure that that cost will be any more valid. So they went on over the budget, they kept spending, so they never had a very accurate monitoring system to capture the correct costing. That led to their prices at times for specific services were less than the actual cost incurred in delivering that service. Very, very typical example was they had a fixed consultancy to certain highly paid specialists, but they never could even recover those costs in certain cases. So it was more a typical charity than what was intended. So that was really not the intention behind which they started that not-for-profit organization, but they ended up being that more than doing business in a right way. Then I looked into what were their auditors doing, what were the audit systems doing, how is their reviews on the audit mechanisms that they follow. Found that the auditor were called just once a year, just before the deadline for filing their returns, because doctors were so busy. The entire management crew was occupied through the year with 70-75% capacity utilization. In some years it was going even up to 90%. Obviously everybody is busy, doctors are quite busy all the time, so they never paid attention to audit functions or review mechanisms or even feedbacks from what was coming from the patients whenever they had some issues. So the attention was not given to the right places. So that led to no effective audit mechanism to get back information, the correct information to take the right decisions. So the budgeting, the monitoring systems kept failing over time. Not that they never had any. They did have certain reasonable budgeting system. They had certain monitoring systems too, but they were not mapped together. That was very, very critical. They never mapped them to say what is budgeted, what is actuals, and how are we going to look at expansion? How are we going to look at cutting the cost? Nothing was thought about. It was budgets were just to see how much more money we need to have the cash balance for to run the system. And whenever they had surplus months, you do have surplus months. We know that certain seasons of the year when more patients land up in your hospitals, then you would have a situation where there will be more cash left in the system. Suddenly, the promoters would like to move it for some other purposes, and there was no exact planning that was for the rainy day kind of a situation. So there was always somebody writing the check. So that is how they kept the comfort going. Therefore, there was a lot of inadequacy in our financial or accounting hygiene as well. When I say what is accounting hygiene, I mean, it looks, we have seen a lot of hygiene word used in the last 6 months, but this is perpetual issue. If you don't have a good accounting system to capture payments or realizations, for instance, if let's say you're giving an advance to somebody and that advance has to be recovered on time and that was not monitored properly, there were times when there were advances from, let's say for an employee, an advance was given and it was decided that they will be recovering it every month. And some months it was missed out. And when we asked these questions, they said, well, HR did not report it correctly, and one would blame the other. And there was absolutely no accountability. No one took responsibility to say that, am I responsible for this? And what am I going to be if I don't perform? What happens to me? There was nothing like that. So lack of accountability persisted. Accounting hygiene was compromised. Sometimes, not for things that were not a revenue was considered as a revenue. Certain times revenues were kept in liabilities as to be repaid, and books would just get closed because audit was not effective. There was no internal review mechanism. There was no feedback from systems. So they even lost track of advances that were collected from the patients were kept in abeyance as a suspense account. So it was never reconciled for many, many days, on many, many months. So these things often happen because the dependency from the ownership on the accountants were very, very high. Then what let them down? They never had a finance person. They had an accountant. So there is a big difference here. So what is this accounting versus finance? Why are these two different? Because no one looked at the money's inflows, outflows, treasury management, where to invest, where not to invest, whether to acquire asset by capitalization, I mean own asset, or you lease it. No such planning. Whatever was required, it was just reported, and then someone would take a decision in the value chain. So these led to a lot of inconsistencies and failures in capturing the right data. And because lack of availability of data, there was inadequate decisions, and that one led to lower returns. And that is when management felt, when we pointed out these issues and said, look at your balance sheet. Now, this is your P&L, which is talking about, when I say P&L, it's profit and loss account, which is typically capturing all your incomes and expenses for a period. And balance sheet represents your net worth, the assets, the liabilities, and what is the shareholders' equity, and all of those. So when it came to looking at the balance sheet, I found that the asset value, that is the investment in land and building, was much higher than the business value itself. So look at it. You have a services business, which means the most intelligent way of doing a services business would be to have an asset light model. If you are looking at an asset heavy model and you top the business on over that and value it separately, the cash generating asset, which is your business, if you put them together, it balloons up the valuation. So that's what we saw, where it was looking to be about 120 crore valuation. if I wanted to go to market and find a buyer, no one's going to touch it, because unless he's a real estate a dealer or something like that who is interested in the real estate value of an asset, or he's looking to park his money somewhere that he's earned. Otherwise, I could have bought probably 3 such units if it was all an operating model rather than an asset heavy model. So that was one of the critical aspects. Now coming to inflexibility entity type, why is this word very important? Look at what I said. Now I said asset was so heavy, business was so light now. So when we put together, the ballooned up the valuation, but it was flexible enough to take. So common sense tells you, why can't you just separate the business with the asset and then do the business? Yes, absolutely correct. But it should also be possible, because the entity type is such that if you want to separate the asset and the business, you are almost impossible, because if you register yourself as a public charitable trust, believe me, it's going to take you not less than 3 to 4 years to get a charity commissioner's approval to move any asset out of the charity public charitable trust. So now who is going to look at it? Even if you want to bring in an investor on board, you need an approval, because the trust deed is certified or approved by the charity commissioner, and for any changes you want to make to that deed, you probably have to go back and give a lot of explanation as why you need this person on board and what is the reason, and etc., etc. So that leaves him with absolutely no flexibility to move around. And even if I want to exit the business today, which of course is not the intent of the organization, though I just gave them a spin-off thought saying, if you want to exit, budget for 3 years to exit, because you need the approval of a charity commissioner. So it almost paralyzed the whole business model. Now friends, you now know what I'm meaning by saying what went wrong here. Okay, so the whole thing is about smart financial management techniques. They never employed the techniques that are required for for managing business, and this is true. So for any organization at any stage of their life cycle, because whether you are a startup or you are in the growth phase or you are in the mature phase of your business, it doesn't matter. You have to be conscious of your financial management right from the day go. Even before your blueprint is on there and you go get your permissions to start your business or your services, think of this first. How good is my financial management? Initially, often, it's all a presumption. Why do I have to put money on something which is a cost center? Why do I invest on a cost center? Why can't I just manage it with somebody, maybe somebody in the house, like a spouse or children who are we are supporting you, probably manage the books for some time, and then we will see when we really can manage. Yes, of course, when you're very, very small, when you're very inactive or just in the initial phases, you may probably do that, but still you have to remember, it's not just about financial management. There are a lot of other associated things like your legal and various other factors, which I'm going to talk about, and Radhika is going to talk about, as to how important this whole thing has become. So now, having studied this case, I'm sure you all have come to some amount of reasonable confidence about what I'm going to talk today, because otherwise this topic is extremely boring, trust me. I'm saying this too many times, but then the reason is that's how it's perceived, because this is not a very interesting subject for especially professionals who care about something else. So it's important, even if you don't do it yourself, you need to have the right people doing this for you. So having said this, I will go away from the case study. If anyone had any questions on the case study, we'll reserve the discussions for later, but no names will be mentioned. Please don't ask questions on which is this hospital you want to buy. You may have to contact me separately. So let's go to the next slide, Radhika. So So having said that, yeah, thank you. So having said that, I've kept the diagram as it is because the core of this whole thing is the financial management in healthcare. That's what is the subject, and therefore everything is going to be around. What do you mean by planning and evaluation? So evaluating the financial efficiencies of your current operations and planning the future. So you got to have, you have to evaluate your financial efficiencies where you are if you're a already operating enterprise. If you're a startup, you have to evaluate your current financial efficiencies. You need to know where you are and what kind of monies are we making, where our costs are significant, what are our environmental factors around affecting us. Is it regulatory? Is it internal or external? We call it as an internal risk and the external risks. Okay, internal risks are your typical internal controls that are there in the organizations, and external risks are your regulatory risk can be an external risk, or your competition can be an external risk. Some huge hospital, like typical, let's say a multinational hospital comes and opens a shop right next door. So are you going to be affected by it? Of course, you're going to be affected by it to a large extent. So in your community, at least where you're dependent on right now. So therefore, you got to evaluate when you're either investing fresh or you're going to expand your business. So many a times I've seen this, small hospitals or doctors, clinics, or even not too very medium-sized healthcare units reinvest into modifying or modernizing their infrastructure. So you have to be very, very cautious on what you are spending. So just to don't be worried about competition and create an expenditure for yourself. So you got to be very careful in choosing what's the right mix for you. So planning becomes extremely important, and your financial effectiveness is very, very critical of your current operations and where you are, and from there, where are you planning to grow? So for the future, you got to have a very good plan in place. That's what I mean by planning and evaluating your business enterprise. Of course, this is very strategic. It is always done at the top management level or the ownership level. But of course, it is important to involve people across the organization to these decisions, because some of these inputs that are derived from these managers at various levels, I can call it managers for convenience, but you might have your own structure of your hospital. You might want to have a very consultative approach on how you want to plan and evaluate your investments. Then comes your investment decision, like we looked at in that diagram. Of course, sorry to step back, and the planning also means what kind of enterprise, look at the right side. I've put on the key components where I've talked about enterprise structure. I have a separate slide on that, which might be useful for all of you. Because it's integrated with your plan. Like I initially started saying, you are going to be built to own or built to operate or built to exit. You are going to decide basis that your entity structures also. It's going to play a significant role on your decision making. So having said that, the investment side of the whole thing. So when we talk about investment, your investment has to be primarily an ROI decision. Remember, what is ROI? It's a return on investment. If you put in your money, if you're pursuing passion for charitable purposes, like my friend did, it's absolutely fine. If you're just doing this to have a correct balance between passion and survival and the growth and leaving a legacy behind, then you please stop and look at your ROIs as to what does it mean, because the passion shouldn't lead you to a downfall or any stress in the future on your financial modeling, which will end up leaving an organization to almost its insolvency or liquidation. Okay, so you have to always keep an eye on your ROIs, whether you are in level of growth or in your mature stage or in your startup stage. keep your ROI right in front of you. And of course, the decision on investments are primarily to talk about whether you are going to always buy or you are going to lease. Look what my friend did in that case study I told you. He went and bought everything and anything under the sun. He just didn't leave anything to be a rental model because he loved owning things, right? So that helped him to build an asset base. But what was valued ultimately was the real estate, not the business. So that was the problem. So one, we need to look at, you own assets, absolutely fine. You need to own assets. I'm not suggesting that you all shouldn't own assets, but own it in a different structure and lease it back to the business, because the business should pay for the owner. It shouldn't be the owner is working for the business should start working for the owner. So always this is a concept that you'll have to register in your mind. Your money should earn for you. You shouldn't be running to like you're running to earn the money. You should also at some point, it's like pedaling your cycle uphill. You have to give all the momentum that it requires to go up full speed. And once it reaches the plateau, you just should be able to take your legs off and it still should be moving. Just that when you need to pedal again is when you're getting another slope. Until then, you should have the freedom to also come out and get in. So you should leave that flexibility to yourself and detaching your business to your decisions. So it was very important to structure your investment decisions very carefully, whether you want to hire equipments, because equipments go out of date. Suddenly you see someone coming up with a very high-tech instrument and completely making your instrument or investment redundant in your industry. It changes so fast because even the manufacturers are inventing constantly. So they are upgrading their system. So your operating model should be such that you are able to quickly exchange and make money out of that, rather than losing and getting stuck with the old instrument and trying to cash out of it. And again, reinvesting on a new one. So you got to have that decision right from the day go. As much as possible, take my advice, go on asset light models so that you are more flexible with your business on your expansion, right? So that's, this is something out of subject, but just to let you know, when people ask me, you've built about 6 offices in the country and 2 offices abroad, your firm is growing so well, why don't you own your own office? Don't you dream about owning your own office? I say, that's the dumbest decision I will ever make, because if I want to own something, I'll buy it in my name and I'll probably lease it to the office. So I continuously get revenue out of it, not to make that investment dead. Because once you sit in your own car, the investment is gone. You are driving wherever you want. And then, of course, owning assets doesn't mean that you should become one Buddha. That's not the idea. So the idea is to make that right decision, right? So when you want to own the asset, when you want to lease it, is a very compelling decision at times, but it is a very it has to be a detached asset decision from your passion of doing business rather than owning assets. So you can have a passion of owning assets. That should be a separate decision, not linked with your business. So that's what I mean. So coming back to this, so the market, the location, so all of that plays a very significant role when you make a investment decision. Next, to talk about financing decision. Often we think, I have to live a debt-free life. See, we all hope that, right? But we are always indebted to something or the other, right? If not money, if in some other form. But here I'm only talking about money. So when I'm talking about indebted lifestyle, this is going to be the problem, because sometimes your money can work smarter than what you can imagine. But because there is one client of mine who's not here, outside India, so who often tells me that I put all my money in the business. I said, okay, what happens if something goes wrong with your business? So who's going to give an insurance to that? Then he looks at me and says, well, I never thought about it. I thought I'm never confident about leaving my money outside of my business. So I'm always putting my money inside the business. So whatever I earn, I pull it back. I said, that's again not so intelligent always. It may be good, provided my friend in that case study was making at least a minimum of 12% EBITDA or a 16% EBITDA. I would have been happy to have told him to put his money into the business. He was making 4% EBITDA. Then I said, why on earth I would not go put in fixed deposits and go watch TV and be with my kids? Why am I wasting my time doing this? I'll go be a professor somewhere, put your money in the fixed deposit. At least you're doing good to the society. So here you are taking a decision to put your money back into your business or putting own capital all the time. So that doesn't mean that you're going to do, you're going to always borrow. So you got to have the right balance. So own versus borrowing is very, very important decision, and to what extent you will borrow. And of course, it is limited by various other aspects. And I'm sure a lot of things are running in your mind when I'm saying this. It's very easy to give gyan when you're talking about it in a conference, but when you go to the market, there's nobody to fund you. Not necessarily. In the past, of course, I would say that it was only banks who were funding healthcare and education or any such professional services. But today things are widening up. You all know it, and that's why these conferences are so useful for you all to say that how you can raise your capital, right? You could raise your capital from equity markets, private equity firms, venture capital funds, banks and institutions, even family members who are having monies to park can be sourced to invest in your business. And you should have instruments that doesn't let them take control of your hospital and you are becoming an employee in the hospital. That shouldn't be the idea. So you got to have a very, very good and smart decision-making capabilities to say, how am I going to build this investment decision, right, versus the financial decision, because these two are hand in glove, friends. So you have to have a very, very good insight of how you're going to raise your funding. The third important thing, while raising the funding, of course, one more important thing is to keep the management control, the ownership controls in mind while taking this decision. As far as possible, you have to be in control of your situation. And I am very, very sure those who are in participation in this program or elsewhere, doctors are definitely exposed to these aspects of it nowadays. And they're also doing a great job. Some of them I know are doing a fantastic job in terms of how they are managing their control versus their ownership rights, while they are having the freedom to operate the business with somebody investing the money. So which is very important. And the next very, very, very critical aspect is your working capital management, right? Cash is not an surplus asset anymore. So you got to have a fantastic mechanism, particularly on your marketable securities. What are your marketable securities? When you make investments in any other hospitals or any other healthcare systems or anywhere else, you need to see how your marketable securities are performing in the short run, so that you are using the money back and giving the flexibility to keep your reserves in a safe place, and you can access it whenever you want. And your receivables, don't let your receivables out of your sight. Always monitor it. It's such a mundane activity, but trust me, it's a very, very important activity. Most of you may be operating on a cash and carry model, but then that's not always going to be the situation. When in a growth scenario, you're going to, like Radhika mentioned in the beginning, I'll connect back to that statement where she said more and more it's becoming a third party making a payment than the service receiver making the payment, which means your insurance companies are stepping in now, corporates are stepping in to pay. You have everybody else other than the receiver of service paying for it. When that comes in, there are lots of regulations around it. When there are dominance of insurance companies over your payment structure, you have regulated pricing structures, you have regulated payment structures. Even now, government is also interfering in saying, I'm going to cover the masses at large and pay them. So it's going to be a challenge to deal with this decision of working capital management, which means that you have to be very, very close. Your ears and eyes have to be on your receivable management and your inventories, because pilferages is the word for healthcare, right? It's closely associated, because you always have problems with, all your consumables missing from your inventory list and your physical inventory. So how frequently you are mapping your inventory systems, what kind of inventory mechanism you have, how is your count on that, what kind of valuations that put in. because they can easily, your accountants can be extremely smart. They will, if the missing inventory can be made good by overvaluing some inventory that they already have in stock. So you may not even realize it because you don't have the time to get into it. So look for automation wherever you can, especially in your day-to-day affairs. So you get reports coming in, you know what are the quantities, how they are managing, who's reordering levels. So you don't block your money in inventories which could lead you to expiry or wastage or rather pilferage as well. So this is one very, very critical aspect. Even this can lead to fraud. Now, fraud is the next very big subject that's coming around. Someone told me that the larger accounting firms in the world, like the, I don't have to mention the names, but the big fours or the big eights or the big tens of the world are talking about fraud management services. I was asking this question, what do they mean by that? Is it like a fraud managing, how to manage frauds, or how to stop managing frauds? Or what is this that they're talking about? I mean, how to stop frauds happening. So they have to coin a different word for it, I guess. But this is very critical. So you need to keep a very, very close watch on. When I talk about frauds, it need not necessarily be cash frauds. It could be accounting frauds. It could be completely a teaming and lading exercise that happens in any organization, and healthcare is no exception to it. Yeah. Then we talk about the contract management. We have separate topics covered in contract and financial risk management. I'm going to let Radhika speak on the contract management more when it comes to that slide. Now I'm not going to let her speak, but I will make her speak when she's going to get over the slides. Because these are very critical aspects of your business financial management. It may say this looks legal, it is not finance, but there is such an overlap. Trust me, when Radhika and I met 10, 12 years ago, we just thought, you are a legal person, I'm a finance person, what is the kind of work that we are going to do together? Today, we are not a single assignment where we are not working together. So there is always legal to every financial activity, and there is always finance to every legal activity. I put inverted commas, legal activity. So I'm completely, therefore, sold on this concept that finance and legal has to go hand in glove. It's not two independent activities anymore, because any legal decisions, contractual decisions have a financial implications. Any decision relating to finance has to be watertight with respect to the contracts and agreements that you sign. Whether it is to do with your revenues, whether it's to do with your liabilities, whether to do with even safety of the doctors, considering the regulatory changes, which again she started talking in the opening statement about how the regulators are now getting so involved in the healthcare business and trying to change everything that is that's happening in the system. So at least a country like India. So given that, again, the financial risk. So this one aspect, I'll just talk about it briefly here, and then I will go to the next slide. The financial risk, what is this financial risk management? Many financial transactions that takes place to support your operations, yeah, can actually by themselves increase the business risks. For example, if you are heavily indebted to some organization, yeah, their cost can be so high for servicing. You're practically not working to earn for yourself, but you're working to earn for somebody else, and they can pose such a big threat on your existence itself at some point of time. So you got to be extremely careful about your financial risks that are associated with it. Here I'm not talking about fraud management, etc. Here I'm purely talking about the cap structure, the model of operations, how you leverage it versus own funds, and how you manage your money can also lead you to higher risk. So we will in eventual slides look at how to control these things, how to manage them. Yeah. So having said that, this is what this slide is all about talking. And on the right side of this slide, we have talked about some key components: entity structure, cost of capital, revenue and payer mix. When I say payer mix, it's about the recipient of the service paying for it, or the insurance company is paying for it, or things such as those. And what is the right mix that you should have in your organization? Of course, it's not such a controllable thing. You really cannot control always, but you need to have an eye on it to see why and how it is changing. And you'll have to align your financial working capital modeling around this and not let it go out of control. So that's why it's important. Your service mix, friends, when we talked about in the previous slide, I said 70% occupancy rate. That was a fantastic occupancy rate. Then why the hell he was at 4% EBITDA? I was wondering about it. I looked at it. You know what? Out of that 70%, majority of the billings were dengue patients. All that they were doing is lying down for 4 days with crocin as a tablet or whatever that tablet that was given to them. There was absolutely no activity going on with that patient except nurses visiting and once in a way doctor coming in. So the absolute, well, it might look very cruel to say that, well, we cannot be choosy about the patient, but some of them can be intelligently managed by your team, where they need not admit a patient when it is not really required and manage them from home so that you can actually leverage that space for another critical patient that might come in, and you may not be out of bed in that season. So you got to have the right attitude and the mix and the governance in place so that there is no compromise. And obviously you will not, I would want to cover about those aspects of it, business and operations aspect. We are all, doctors are very, very good at judging that well. But I'm talking about how it can impact your financial, your revenue mix, so to speak, or your service mix correctly. And also identifying the right core competencies in the hospital. You may yourself be specialist in certain activity, and that's how you would have started. But there may be associated services that may become very critical to be incorporated in your service line, so that you cover the lateral as well as the vertical and the horizontal structure, business structure, so your growth becomes more significant. So your services are boosted out of the other ancillary services. Like a very classic example, if it's a mother and child care, I would say IVF could be one such extension of services. So if you have a very good IVF center, it could lead you to a lot of obstetric services that could come to you from a referral of an IVF activity that happens in your system, because you have billed for the IVF, then comes your extended services for the next 9 months. You are monitoring the same patient, so you're kind of completely covered. So have a right mix, so there is no dull day to your business modeling. You got to keep this moving. This wheel will be always moving. You got to keep changing that to the requirement, and locationally also it might have impact. So you got to keep that in mind. Of course, the cash flow and working capital management is something that I already spoke about. Budgeting and working capital, which was the fallout in our previous slide, and which I talked about, and feedback and revenue mechanisms. We have a separate slide on that as well, because it is important. So with that, I move to the next slide where we are going to talk a little bit. Radhika, I need your help.
Sure. So, Srikanth, what I'm going to suggest is that before that, do you just want to talk about taxation, since you're on for the financial management, and then I could talk about planning and entity.
Flipping slides. We'll come back to the entity structure as well. But Radhika, I can go in the same order actually. There's nothing wrong about it.
Do you want to talk about the entity structure first, and then
and then we can come to the taxation aspect of it? Yeah. So friends, we talked about having the right kind of planning your entity structure. Okay, I know most of you are already aware of what is available in the country. At least this is very India focused at the moment. So if there are any viewers from outside India, probably we might have to separately advise them. But this is something that's very important for Indians. So particularly there are several components, to consider it. But comparisons are between proprietary and partnership structures, which are very common in healthcare. You have nowadays the new regulatory framework which governs the LLP structures, the corporate structure, which is a very, very famous structure for most of the organizations across different industry segments, and not for profit. very friendly at times for healthcare and education, but in these days this is becoming a little difficult also. You got to go with the times. You might want to think about it unless you are looking at a bill to consistently stay and it is purely for a certain cause for which you are setting up this type of an enterprise. Otherwise, if you're looking at a commercial establishment for a profit making objective, along with a good service, quality service organization, recommended to look at the top three in the order of its preference for you and convenience to handle. And when it comes to decision making, friends, keep in mind your decision should not be very short term or what your chartered accountant is advising, because trust me, this is one thing I hear about often in any organization. There will be a very simple business. You will be incorporated as a public limited company. I would say, what is this public limited company for in your business? They'll say, no, the chartered accountant said this is the best way to set up. But trust me, public limited company means the entire Companies Act will be applicable to that company, irrespective of whether they are listed or unlisted. They are small or big. They will have a host of compliances that they will be struggling to even take care of the operational aspects of it. You need to choose public limited companies, for instance, only when you are required to get into listing your shares and going public or any such larger interests. Don't choose entity types because somebody recommended you that. You'll have to also look at what, of course, you need to take professional advice, which is not what I'm trying to go against. But it is like, it shouldn't be without questioning that as to why you need this and what is the better way of doing it, because it shouldn't be the limitation of the advisor. You are going in for something like this. So always keep this in mind in the back of your mind, test it and then implement it. LLP structures are very convenient now. It is a little better than a partnership structure. The difference being limited liability. Of course, we are talking about civil liabilities here, not the criminal. But limited liability partnerships are more dignified compared to the partnerships per se, because one, it leaves a very different corporate impression, and partnership firms have unlimited liability on the partners, whereas limited liability partnership, by the name goes, it is limited by to the extent of the capital contributed into the business. So you can do this model, but you also have to remember when investors come on board, this almost fails you because you will have a lot of complications operating this kind of a structure, because there is no something like a board seat, or you don't have like an observer seat, and you don't have things like a preference capital into convertible into equity or a debt into equity. All that is not possible. So you got to, each time you change one clause in that agreement, you have to change the entire agreement. So which means the risk of making even simple clerical error in the revised agreement can lead you to a disaster. Yeah. So you got to be very, very conscious about choosing your enterprise right at the beginning. And even if you are in the initial stages chosen a particular type, choose a type that can be flexibly converted into another type. So that way you are not burdening yourself with a cost initially. Later on, you can easily convert in less time. So you should evaluate this option. So that's why this one it talks about advantages and disadvantages, which is there right there on the screen. Yeah, I'm talking things outside of what is just written there also, so that it can be more easy for you to grasp and remember. That's the idea. So I'll go to the next slide, which is on the taxation. So before that, I want to ask Radhika if you want to speak anything on the entity structure other than this.
Srikanth, what I suggest is you finish on taxation, and then I'll come back to these slides when I talk about the legal part of the whole thing.
Absolutely. Thank you, Radhika. So let's go to the next one, the taxation. Well, friends, I have not covered too detailed in the taxation here. I've just left a few thoughts about it, because basically what is TDS is tax deduction at source. This is very critical for, so when you set up an enterprise, whatever form it is, it doesn't matter. You need to take something called a tax deduction number. Then you'll have to take something called a permanent account number, which you are all familiar with. And why is this two different things? Tax deduction number is any payments that professional services or consumables or any services that you obtain you are required to deduct tax at source. It could be basically rent or any professional charges or salaries or anything that you pay. You please have to be very careful that any entity structure other than the proprietorship entity structure where you and the business is not different. Other than the proprietary structure, all other structures requires withholding tax. Of course, the trust doesn't also has certain exemptions. So, barring that, you have a withholding tax model, what we call it as TDS in our technical language, and where you will have to deduct the appropriate rate. Be very careful about choosing the rate because sometimes you might take a certain kinds of professional services which will only be 2% withholding. In certain cases, it is 10% withholding. In certain cases, it is 15% withholding. Some cases, it is even 40% withholding. Let's say you have a foreign doctor advising you on a certain transaction and you're making an overseas payment. So you will have a maximum marginal rate withholding tax on the payment. So it's not free from withholding taxes. Please remember that. And when you make those payments, you'll have to also get certain certifications from a chartered accountant, and then you have to file with that with a bank, which they will be compelling you to do, without which you cannot remit the money. And when you do so, when you are signing up these contracts with these doctors outside, you also have to ensure that your tax clauses are coming in carefully drafted in your agreements. Otherwise, you will end up grossing up the tax because they always assume whatever is negotiated is what he's going to see in the bank account. And that's often in any industry, this is a common issue. So I'm highlighting it, especially when you are using services of an overseas consultant or an hospital or any other service provider. So that is very important. And also there are return filings for these on a periodic basis. So keep in mind that you have to keep someone doing this regularly without errors, and these can be reflected in the websites of the government of income tax department websites, where you can frequently see what has been uploaded, because there could be errors in what is withholding done and what is coming in the returns, what is coming in the website. So you have to have someone periodically reconcile these balances so that at the end of the year you don't have a struggle of carrying forward wrong numbers in your books. And when you're taking credit for this withholding tax, tax department will send a notice saying you have overclaimed your deductions, and whereas rightfully you would have been claiming it, but because of there was an error in the tax department uploading, you will be running from pillar to post to sort out this issue and spending more money on consultants. Again, everything costs you. Because you don't do this as a routine exercise, you will end up paying a professional at the end of the period. So it's cost now or cost later, it's never free. So you also know that. So therefore you need to have your regular accountants take care of it, so you don't have to spend that extra money to get a consultant to go and represent before the authority to sort out this issue and get a big invoice. So timely and appropriate deduction of tax, which I've talked about, which is very important, because if there is a due date within which you have to deduct and remit, please ensure you deduct it. Sometimes you make advance payments without deducting tax. So you are still liable to deduct tax, even if it's part payments, advance payments. So don't forget to do those things. And if you are in doubt, ask your auditor, consultant, whoever you are comfortable with, to have a complete knowledge, and make sure your team, accountant or your finance team, is completely familiar with all these concepts, so that they can, if you're interviewing somebody on this, you should ensure that they know these basic things on how the filings happen, what is it, so that they don't make mistakes and you don't have to pay the price for it. And of course, the annual returns filings and the periodic filings are very, very important. Advanced tax payments, which is based on your future projections. It costs money, because all these places you can save money, because the income tax department is not cheap. When you don't pay the advanced taxes on time, you're complicating it. You have 274 section completely applicable, ABC, they will go in the order and compute the tax, and at the assessment there'll be a big number that will get added to your penalty and interest. So keep in mind all these things. I had a very typical situation, when I was driving one of the Japanese company's CEO. I was driving with him together. He asked me, casually, he said, how do I make profit in India? It was a very deep question. I said, keep your compliances and your regulatory compliances and your tax payments correctly done on time without delays. You know, that itself is a huge saving for you, because that is where your margins are going to be stuck in the future, because your advance tax you are paying, GST you are paying, your profits are in the taxes. If you are going to make mistakes here, trust me, your money is going to be blocked there for I don't know how many years till you sort out your legal issues with the department. So keep this always in mind. A smart way of managing money would be also to keep more cash with you, not with your tax departments. So that is very important. And it doesn't mean that I'm not in no stretch of imagination. I'm telling you don't pay your taxes so you keep your money with you. That's not what I'm saying. And often I have heard very interesting things about doctors. You know, when we are making payments to consultant doctors, they always say, I don't want any taxes. I have agreed for this amount. I need this money. But they don't understand they also have to anyway pay taxes for that income. So it's not like if we pay them the full money, they don't have taxes. Even if you pay them full money, somebody has to pay this withholding tax, and again he has to pay the tax. So it is like double taxation for the whole thing. So he may as well take the withholding tax. So, and of course he's going to, unless of course the payments are all in different forms, and then of course that is not what I'm talking about. If they're all check payments, and obviously they will have to be after subjecting it to tax. So your contracts with consultants also are very important. Even for the doctors, it's very important to have a very good agreements in place with the hospitals so that they can manage it better. Well, so which kind of moves to the next slide, Radhika? So that finishes the first part of my area, which now I will hand over the floor to Radhika Bali, who is going to talk about risk management. I might keep jumping in between because I'm an auditor. I can't stop talking, so I'll keep coming in between. So don't mind me for that. But she's going to talk about the risk management. Thank you, gentlemen, for listening. Thank you, ladies and gentlemen, and the panelists for giving me the opportunity to talk on this. And I will formally hand over to Radhika to take the next few slides.
Thank you, Srikanth, and it is a fantastic thing to listen to you in your element, I must say. When it comes to legal in healthcare, right? Let me tell you that everybody's always asked me, legal in healthcare is all about compliance. The compliance is the least of your worries, and I'll come to why I say that. So what are the three cornerstones on which a legal regime of any healthcare institute, be it a super specialty, multi-specialty, single specialty, what are the three cornerstones on which a legal regime should rest? And the first thing I've always maintained this is that your legal regime has to be ethically right. It's only when you get it ethically right is when you're going to get it legally right. And ethics, again, very subjective. Your ethics is different from my ethics, okay? But when I talk about ethics here, I'm talking about patient service as the focus of your organization, of your service. If your customer is happy with you, your customer is going to brand and talk to you about this, or talk about you to the world, okay? What has legal got to do with this? Trust me, legal has a very, very critical role to play when you talk about this, okay? When we started advising hospitals, that was around, 20 years of practice, and 20 years ago, I think, yes, that's when I got involved with medical industry. Very, very different regime at that point in time. But that time, hospitals did not have a audit review mechanism. The belief for a very, very long time, even till recently with the senior consultants and surgeons that I talked to, they very, very thoroughly believe that, no transparency to be brought into their internal operations. The case study that Srikanth spoke about, another couple of case studies that we advise on the northern side of the country, that we are advising on these hospitals, I'll tell you that this whole rigidity about not building a transparent mechanism, this whole rigidity about not building an audit mechanism, a feedback mechanism has cost as huge losses to organizations in the long run, right? So build a regime which first believes the first cornerstone is ethics. Build an audit mechanism, do your death audits, do complications audits. The government is not mandated it. You do it as a group of hospitals, you do it as a group of surgeons, and use that audit finding as a feedback and review mechanism to build in that accountability that is there. One industry, I must say, where every stakeholder in an healthcare institute just does not want to be, is not willing to be accountable to the other stakeholder. And I'm not just talking about stakeholders being the guys who fund you. I'm talking about your surgeons, I'm talking about your staff, I'm talking about your RMOs, I'm talking about your doctors, I'm talking about your nurses. Make them accountable. And how does accountability work? In a healthcare organization, accountability has to be top to bottom, review has to be bottom to top, always. Many of you may think that this is very theoretical. We have implemented this in good hospitals across the country, in different specialties, in different sizes of hospitals, and trust me, the outcome has only been positive. It has been a lot of gain for the hospital, for the founders, for the promoters of the hospitals, as well as for those who have invested in this hospital, right? Now, let me come to the second part, is compliance and documentation. I will be very frank with you. Law, the legal regime of the healthcare, they do not understand the hospital industry. Okay, a legal regime is built by a executive or a legislature body of the country which does not understand how the healthcare system works. I mean, the classic example is Prenatal Sexual Determination Act. The other, of course, is this 20-week medical termination of pregnancy, being extremely rigid about it. Then you have the surrogacy example where they are not, not willing to budge on understanding what is the reality of surrogacy. So many things, right? But what choice do you have? I mean, you have one choice to talk about in a forum like this. At an entity level, at an organization level, you have no choice but to be 100% compliant. And 100% compliance is something that you have to realize is not something that you necessarily have to have in-house. You can outsource parts of it, but create a regulation mechanism to measure whether your compliance is 100% or not. Do not wait for your auditor to come and measure this. Create a compliance regulation mechanism in-house. The second thing is contracts. I, for a very long time, even today, find it so difficult to convince healthcare owners, institute owners to say, get into good contract management with your consultants. I mean, there's one part of the country where it is believed that consultants don't sign contracts. But let me tell you, consultants who don't sign contracts are the same consultants who come back and say that we have a legal problem. How do we get out of it? So what should be the way you build a contract in healthcare? Now, forget the legal part of it. Let me tell you, your contract has to be built in a manner where you have put the organization in the front, and then comes its stakeholders. Okay, never compromise on your organization liabilities, never compromise on your organization exposure, because your industry is such where if there is one liability, whether it goes the legal route or not, the fact that it will go the media route itself will bring you down, itself will hurt your business very badly. So build your contracts with keeping the organization protected, the institute protected, and then comes the protection of its stakeholders. And when I say stakeholders, again, it is your people who work with you in the organization. The third thing is insurance. Insurance.
Your voice is cracking. Can you sort of repeat the whole thing, like from the past 5 minutes?
Radhika, I think we lost you.
I think Radhika probably has some network issue from her side. I'll just check that. Sorry about that.
That's okay. That's okay. Srikanth, while we are waiting for Radhika, can I ask you a question?
Oh,
I
please.
think the point which you highlighted as a case study
Yes,
was is very relevant to all our viewers from the point of view, because many nursing homes or smaller hospitals may be running under heavy losses like that, because what happens is the land is owned by the parents or whoever started the hospital and a nursing home, and they don't pay rent, and so they don't calculate the um, expenses, and because they are getting cash flow, they may not realize the profit margin is very low and EBITDA value is very low. So I mean, if you can, or Radhika is back, maybe I can ask you later. Briefly, can you explain how to avoid that pitfall? Or is it worth all the nursing homes to revisit their finances once a year or once in 6 months?
So, just to answer that question, Doctor, thanks. That's a very, very pertinent question, because so in the case study I gave was another extreme where the monies are free flowing. It's more a reimbursement model as far as the doctors were concerned. But on the contrary, where there is we have a significant amount of leveraging that is done, where the funds are borrowed, and there is a cost attached to those funds, and then we are running these healthcare units. Especially, you have to have a very right balance, in the sense you have to have this planning constantly. It's not like you can visit half yearly. There is no parameter set like that, at least in the initial phase of your setting up. Very, very important thing that you need to tie up is what is your investments versus what is your return on investments. You got to, I'm helping today a particular healthcare unit to expand into another city. Now, this is a fantastic case study for me to also talk about, but I didn't have any presentation to show you. But I can just tell, first thing that we have done is 3 to 4 months, we have only invested in arriving at their cost. I have not done anything else. 3 months I have spent understanding every rupee that is going to be spent on that particular service. And I'm working on a break-even point. To arrive at the break-even point, to say what will be my minimum number of patients that I should have in a year for doing this in the 3 or 4 services that they have. What is the volume of patient footfall or the consultation that I should have in order to break even. So I have to prepare the investor or the owner of the hospital to know if he is going to have that kind of money available or the sources available, what we call the runway capital. You need to have something called a runway capital. You might, if you are just putting up a clinic in your house, in your garage, you don't have to think so much, because there is no infrastructure cost, there is nothing much, but you just, 100% of your fees is equal to your profit. But in a situation where you are talking about a unit like where you rightly pointed out, a mid-size, smaller health unit, this is a very, very critical aspect. They have to be very careful right at the beginning. And if they have not done that in the beginning, and let's say they are 2 years down the line or 3 years down the line, they are already struggling to meet their ends, it's important for them to downsize it, what we call it as shrink to grow. This concept has to be understood. The shrink to grow is very important, because it's not about uh, investing more to grow. You have to at some point of time shrink to grow, which means somewhere where you are, let's say for example, you are on you are buying assets, you move to leasing model, don't go to buying anymore. So link your cost to the day-to-day revenues and see whether this investment in additional asset is going to bring in the revenues, because every asset has to be a cash generating asset for you. Otherwise, it's a wasteful investment. So if you go and put up a fancy looking clinic with no patients walking in, those maintenance cost and the fixtures that you have put in has already gone wasted. So you have to have the right balance between what you want to display to the world versus what you really are able to deliver. So it is like a fine dining versus a basic restaurant which provides the full quality food that you want to eat. So it may not be a direct comparison, but nevertheless, in business sense, I mean, to answer this question. So it's a continuous effort. And once it's like pedaling your cycle, just same example I can give you. You have to build that momentum initially where you are involved in pedaling that cycle. So once it reaches a certain stage, then you can take your legs off and pedal only when it is required, which means you know by then what is that sustenance period by which I don't have to be involved on a day-to-day basis. I can come out of it and get back only when it is needed, when you have the right people managing that. And doctor, it's very important to have, you may not be able to take this cost initially to have a very sophisticated team to advise you, and if you don't have the knowledge to do that. Nowadays, you have most of the advisors who can be part of your growth team. You have to choose your right consultants and keep them with you and work with them to build your practice so that you're always watched, you're always been advised correctly. And of course, final decision will always be with you, but you just need to be having these advices coming to you at every stage. So everybody looks into your numbers, advises the right thing to do. Then it may not be difficult. Even the example case study, to go back, we have done that. Even to revamp their business, it's going to take us a year or two from now to set right, but definitely their EBITDA is expandable within the existing infrastructure without having to do much because they've already invested in all the assets that are required. Just that it was not concentrated well, the mix was bad, the approach was not good. So we can tighten up all that, remove the unwanted frills in it, and be a simple, effective organization, which can still bring in. So the core activity should not be compromised, but we can work around to ensure that there is a healthy finance management mix. So I don't know if I've answered your question, Doctor.
You did, Srikanth. Thanks very much.
Thanks.
Radhika,
Radhika, to you.
Okay, sorry, power outage. Okay, so I was talking about insurance. So, your contract management with your insurance, with TPAs, you have to regulate in a manner which not only brings in, accountability mechanism in-house, whether it is your finance, billing, accounting department, but also where you are critically making it very, very clear to even your consultants that how does insurance affect, the classic example I always give is doctor notes. Okay, I know that doctor notes, when I started talking about it a decade ago, nobody was willing to say that doctor notes were the most not understood documentation in a patient file. Okay, and the reason is that so adversely affected the insurance coverage that a patient had with his or her insurance agency. That was just one aspect, but we have over a period started explaining that doctor notes are not necessarily supposed to be in handwriting that nobody understands other than the doctor himself. Okay, there are so many other aspects where you can in-house bring the clarity in showing transparency in understanding how every action of every resource within your organization has an impact on the eventual, not just profitability, but like I said, on the patient care. How does patient service or the care of the patient be affected positively if you take care of these issues positively? The third most critical aspect is your organization matters, and therefore your organization's growth matters. I firmly believe that every healthcare institute which is out there to provide a good service, a good patient care to its patients, necessarily needs to grow. And a corollary of that is something that I, Srikanth, another, our partner, venture partner, Megha, believes in thoroughly, is that very good, affordable healthcare is possible, and it is possible to make profit with all of these constraints that we have spoken about today. It is possible. Draw a map of working, having an organization that is going to be flexible, is going to be scalable. Take the pointers that Srikanth has spoken about today. Do not just invest all your money. Do not make it capital asset intensive heavy. Work on the pointers that we spoke about. Understand what are the ground realities of your industry, of your service. Work on an audit feedback accountable mechanism. Make every resource, every stakeholder of your internally in the organization accountable downwards. Make a review mechanism which goes from bottom to top, where every person is accountable. Put the organization in front of everything. Create a profit transparent mechanism in the way you're working. The biggest thing that has come to healthcare, and now of course is coming to all other services, particularly even legal, is the legal tech. What came to healthcare very first in the Western world, and now of course in India, is the health tech. Do not ignore what's happening in the health tech mechanism. The way going forward is going to be technology that's going to be a decision maker, that's going to turn the tides in the healthcare industry. Invest very early on in good healthcare tech, whether you inbuild it, whether you outsource it, whether you take a base outside and then you inbuild it. And I'm not just talking about your Palash, okay? I'm not just talking about your HRMS and all of that. I am essentially talking about those technologies which will create disruptive changes in the way you provide services. And let's look at robotics. We are advising a robotics company, that has come. And let's look at them, understand that when you have technology coming like this, it is not just going to mean more business or more revenue. It's going to mean less liability. Okay. And you as a group of professionals have of course been very vocal about how exposed you are when you are providing a service. And I empathize with that problem gravely. I mean, we advise extensively on that also. So I'm telling you that look at health tech right in the beginning of your organization to imbibe it in the service that you provide. Quality certification, another thing which was not very well received a decade ago by many healthcare institutes that we spoke about. Of course, you have the NABH certification that is there by the government. But I have advocated one thing very vociferously in the recent years, and I have said that those hospitals which form a particular specialty, a particular group, should look at a co-certification mechanism. And what is it that we are trying to say? NABH looks at you as a infrastructure, building, floors, management, OT, equipment, all of that. What you need to build is a certification mechanism if possible. Do it ad hoc in the beginning, but if possible from a patient care perspective. The eventual service is your patient, okay? If you can help build a certification mechanism, are willing to participate in such a certification mechanism, it will go leaps and bounds in giving trust, in giving faith to your stakeholders, to the people that are backing you, to the investors who are wanting to come in big money, bring in a lot of growth capital into healthcare in India, and to your patient, right? And the basics of all of this is create transparency in your mechanism. And I'm always asked this, okay? I'm always asked this, how transparent, Radhika, should we be? There is no answer, okay? There is no one answer to this. But if you're going to keep patient care as the goal, if you're going to keep growth as a goal, I don't think you have a choice but to create transparency. And if you think transparency will expose you, I suggest you work on the fortifying mechanism inside your organization first, where I said regulation, compliance, audit, feedback, accountability, and then open your doors and slowly start becoming more and more transparent to your people who are invested in you, people who are dependent on you, right? There's a lot more that can be said about legal in healthcare. It is one of my most favorite topics to talk about, but I won't go on and on. I'd like to go a little further on operational financial audits. Is of course Srikanth's complete forte on this. But when you talk about audit, before I hand over to Srikanth to talk about financial audits, let me tell you that even if there is no complaint that has come to you about a patient or about a procedure or about a whole quarter has gone by and there is no complaint that has come, even about billing, even about anything else. Okay, these are the three things where you majorly get complaints from patients, right? Create an audit mechanism. Create an audit. We used to first call it complications audit. We used to call it death audit. Now I have coined a term which says no complications audit. You know, I have had a quarter of no complaints. I've had a quarter, or I have had 6 months of externally nobody has come back to us complaining about our billing, complaining about overbilling, not clear, transparent billing, or complaining about a procedure, or complaining about a surgeon not visiting, or any of that, and yet do your audit mechanism. So what do you audit in this? You audit your time taken for a patient if the patient is walking in a casualty or an emergency, to how much time it has taken the patient to be, if it was to be hospitalized, then admission, what has happened during the admission, whether there has been a 24/7 at least one visit by doctors, whether the notes are monitored, whether your notes are matching your drug charts, and whether when the patient has been discharged, if the discharge summary, if your advisories have all been captured together. When you create a very, very strong, sorry. Okay, so when you create a very, very strong audit mechanism is when your financial audit will sit on top of it and talk about how financial audits can make the bigger difference when your operations, when your processes, policies, audit is already robust and in place. Srikanth, do you want to talk about financial audits for a while before I go to the feedback and review mechanism? Srikanth?
I'm sorry. I was just still muted when I was trying to talk. This mute word was something that we coined a joke around recently. Okay. So regarding this audit, audit is mostly seen as a post-mortem that you all do for the patient, so it shouldn't be that way. Audit should be something which would give you a foresight into your issues that are out, not those have come and gone and the tsunami has already hit, then somebody's coming and reporting that you are already killed. That is not what your mechanism should be. So this is one of the things that I gave in the case study when I pointed out that the audit used to be a mundane annual statutory exercise. So the auditor would walk in September 1st because September 30th was the last date for filing the returns, and probably rushed the whole organization, and the organization finance manager knew exactly what to give the auditors that he will not ask more questions. So they are tuned now, and they just do this as a ceremony, and they'll go back, and then no one looked into what was the necessity for the organization. So use audit as a mechanism to build your governance, build your forte of managing your finances. So use them for your advantage. You're anyway spending, so spend it wisely. Build something called a risk matrix. So we have something called a risk matrix concept. What you must do is leave the statutory compliance audits to the side. I'm not really so worried about that because that is just a reporting requirement which has to be an annual ceremony. But what you must do is, apart from your operational aspects or compliance related audits that you have, your risk matrix should cover all the key risks that are there in your business and your organization to specific. This is not about general knowledge information. It is specific to your organization. What are your key risks? This could mean your process risk. It could be a strategy risk. It could be a financial risk. It could be even ownership risks. All of it are entity level risks. So what we call it. So it will map everything, and you have something called a metric structure created where you identify the risks, identify them as to be a key risks. No, not everything is a risk also. Everything that perceives to be a risk cannot be treated as a risk also. You have to have a materiality to that risk, and that risk should really affect your profit and loss account or your earnings or your taxation or your existence itself. So that is listed. It could be a few, not too many in a smaller organization, and it can go into pages for a larger organization. Yeah. Then there is something called what we call the control metrics. What we create a risk and control matrix, what we call it RCMs to be more jargon oriented. So the RCMs are created which will map your risks and your existing controls. What kind of controls have you put in to manage these risks? Okay. Do you have, let's say, for example, you have something like, I'll just take the example of Radhika's thing about consultants. Do you have a contract to protect it? Yes, contract is there. Now, is this contract adequate to cover the risks? And what kind of risks are you perceiving in a consultant contract? You have to list that out first. What are the key risks again? It's not about paying is not a risk. You have to pay. So that don't put that as a risk. But overpayment is a risk. Underpayment is a risk. Tax not deducted is a risk. Legal issue is a risk. So you identify in that what are the key ones. Identify those risks. And what kind of controls do you have? Will there be a double payment to this? Is a risk. Will there be a legal issue that will affect the organization instead when the doctor commits an error? Is that a risk? Whatever that is, you perceive it, put your answer to it. Is this adequate? If not, what is the control alternate mechanism that you are going to introduce to control it? Is this automated? Is this manually monitored? All of this will come in your risk and control metrics. Have this mapped beginning of your, let's say, if it's a startup, within about first 2-3 years of the organization in motion, you should have this mapping completely done, because you need little bit of experience also in putting this document together. So you create it with your own experience of running the hospital. Then once you have that, have a periodic check of this. Every year you have them verified to say whether this risk remains as the same risk or has it modified. How will it modify? If your business model changes slightly, it will modify. If you're moving from a consultancy to an employment, it will change. If you move from individual contracts to organizational contracts, it will change. Or any big event that would have happened, or an investor come on board, it would have changed. Your risk parameters would have changed. So all these things you need to capture in and identify. This risk matrix will be your Bible to make sure that you are controlling your organizational governance to its core level. You know, this is a blueprint of how your operations are actually happening, not your surgical operations, but I'm talking about the running of the organization. I'm going one step above the actual day-to-day work. It will give you a complete bird's eye view of where you stand as far as this organization is concerned. So this becomes a recorded information, and over time you see the way it moves, this document moves, will give you how you have grown, will show you how your profitability has impacted on account of this, managing these risks. You will see visible ROI improvements in this. So use this tool very critically. There are also IT products available in this, but I don't recommend it so much, because one who also uses them have always seen, human brains are much better than, how much ever technology you try to use. But that can ease your work in case of volume activities. But definitely you need to have somebody looking into this constantly for you, so that use this audit as a very, very important mechanism. And second thing is, concentrate on your two aspects: internal controls and your internal risks and your external risks. What are internal risks? Internal risks are nothing but your internal control weaknesses, right? You might have some leakage of processes which could lead to there could be a simple thing, you may have partly automation, partly manual. That could lead to a certain amount of risk. I'll give a simple example. You're buying an equipment or any asset. When a purchase order is made, you might make it in a system. You will have a accounting or a process ERP system which will generate a purchase order. Now this is sent to the vendor. Now vendor is supplying the equipment. Now from your organization to vendor, it converts from an automated system to a manual process, because the vendor is not connected with you. So he is an external agency. So it goes out. When it goes out, he supplies the equipment comes into the system, there is a goods receipt note that is generated. So now again, from external, it comes back, it has gone to from automation to manual and coming back into automation. Now you will have a good ERP, let us say, that is recorded your inbound of your asset. Now the invoice comes to the finance. There is a GRN created, and then an inventory is taken into account. When the inventory is taken, there has to be, you have introduced a process that the user department has to certify it, saying that we have received it on this date and then we are putting it to use. Because for you to claim depreciation and all that, you need the date of installation and put to use. So that is a manual process again. It has moved away from the system again and coming back to system when it comes to payment clearance. Now see the number of times it is going out and coming into your system. So everywhere there could be risk parameters that could get created. Where there is risk created, you need to have a control to alternate controls for review controls to ensure that you are monitoring it. One may say, yeah, we automate everything. Yes, you can automate everything if you really have the free flow of cash, like I said in the beginning. So you have to take a correct estimated view as to how big is your organization and therefore what kind of mechanisms that needs to be put in place. If you're a small startup, mid-sized, you may not need everything automated because the cost of automation and maintenance also is a cost. It's a big cost. So you have to be intelligent to know when to draw the line and say, I will live with a manual process here, but I will have a good audit mechanism to oversee this, or a review mechanism that controls it internally. So this is the internal control strengthening that I'm talking about. Then there is an external factor. Of course, the supplier would have given you lesser quantity than what you ordered for, right? That's an external risk that is going to be there. Now, who is monitoring that? Who are the people involved in the system to ensure that the correct quantities are brought in and recorded and paid for correctly? Now, this was the example to distinguish between internal and the external risk. The external risk also is the regulatory risks, the tax changes, the tax rates changes, the new regulation has come in that would have strained your operational activity. So you have, your organization should be always robust to change management. So keep your system so flexible enough to accommodate changes and adapts into it. So there is continuous learning process for your team members in the finance, accounting and legal teams, whoever are there. If you don't have a full-fledged system, never mind. That doesn't mean that you are compromised here. You can always have help from your existing auditors, consultants to support you. And there may be a marginal cost that you might have to incur extra to have them support you, but then it could go a long way to save a lot of large monies that might go wasted and then regretting about it. So that is the operational and effectiveness of an audit procedures that I'm talking about. Well, I can go on talking for the next this, but I will just stop here and move back to the slide to Radhika because I know everyone is getting hungry. So we are almost getting close to the finish line.
Yeah, I just want to finish since we are late.
Radhika and Srikanth, I think there are lots of questions coming and some people want to leave by 7:15. So can we take the question and answer?
Yeah, yes.
Nikhil, are you there? Nikhil? Nikhil Datar?
Yes, sir. Just give me 5 minutes. Yes, sir.
Yeah, Nikhil, do you want to comment on being a doctor and a lawyer on the legal aspects of the medicine as applicable to maternity and newborn care for a few 2-3 minutes?
I mean, honestly, whatever I heard so far was all great and all brilliant, absolutely. But most of it was primarily account side and something which I am absolutely poor at, like most of the doctors, except probably Dr. Kishore Kumar might be one of the exceptions, but generally most of the doctors are very poor about this particular aspect. So thank you for enlightening us.
Nikhil, especially I liked the comment by Radhika, which I wanted you to opine, because she said 3 facts. Healthcare is perceived to be not for profit, it's ad hoc regulated, and needy customer. So what do you think as a clinician about those 3 points? So that's exactly what I was trying to ask your
Yeah, absolutely. It's absolutely true. I mean, I straight away take from an example of one businessman who has a hotel and a pharmacy shop next to each other, literally sharing the same wall. And he was sharing that experience that a guy who comes and idli in my restaurant, he is happy to give a tip of 10 rupees extra. The same guy, when he goes to the pharmacy and buys a medicine, he immediately asks a question whether there is any discount that can be passed on to me. Okay, so that's a typical mentality of people, and that's where we live in. So they are needy people, they are not happy people, they are not happy customers, really speaking, and that's what absolutely is true. Now, for profit is a very big question as to whether healthcare primarily is a calling, profession, business, what it really is a very big question. I would say lawyers are happy and smart people, unlike doctors, so they don't get into all these problems. You will be surprised that lawyers do not have the same kind of even CME requirements that doctors are supposed to have, and the same lawyers will be fighting for those kinds of things when it comes to doctors. Of course, I keep on sharing, I keep on changing my role at all points of time. I remove white coat, put a black coat, I remove black coat, put a white coat, so I can argue on both the sides of the story. Well, we require healthcare to be regulated, but on the other hand, our regulation, as Madam Radhika said, is very baseless and very mindless because it is not industry oriented. Because doctors do not represent themselves sufficiently when policies are made and when laws are made, and that's why we land up making insane kind of laws many of the times, laws which are absolutely great at the top of it, but very poor when it comes to implementation, or rather very impractical when it comes to implementation. And that's why we land up at the grassroots level when we are working over there. We land up into those kinds of situations which are so impractical and so absurd many of the times that there is no realistic solution to it. And the only solution that remains is to go in the hands of the bureaucracy and the red tape and then wet somebody's hands and get the issue sorted and just get it going. But that's not really speaking a great idea. So different kinds of laws which are at tandem to each other, which are many times contradictory to each other, but the same healthcare provision is expected to follow all those different laws because one particular man or an inspector of a particular agency under particular law will come in and say that I don't care about the other side of the story. Under my law, this is what you have to do, and you show the performance. Otherwise, we will penalize you, jail you, punish you, whatever it may be. I think the whole society needs to change along with doctors. When we speak patient safety, many of the times people think that patient safety does not include doctor safety. But if we look at the WHO's definition, that patient safety means and includes the safety of the healthcare professionals too. So something which is conducive to the end user, and end user will not necessarily be the patient, but end user will also be the doctor, the healthcare professional collectively together is what actually is the need of the hour. I don't think we are so very close to that kind of a concept at this point of time. As a matter of fact, all in all, we find penalization and criminalization of things, of errors, of wrongs that are happening is on the rise rather than it should be on the lower side of it. So I think we are going poles apart, and people are thinking unless proved otherwise, the doctors and the hospitals are money making rackets, which needs to be, that myth needs to be really busted holistically. So when we speak of transparency and utmost transparency, many a time that question comes up into our mind as to if we try to be utmost transparent, then will our society be ready to accept that kind of transparency? And I have an example of somebody who called me up, a very, very ethically conscious guy. He said that my nurse has landed up injecting a look-alike, sound-alike drug. And honestly, there was a mistake at 2 o'clock. Somebody landed up giving adrenaline instead of giving atropine, and it's a look like sound like drug. So there's a lot of work done by Cambridge University on how the mind processes, how the brain processes a given particular spelling, so on and so forth. But the fact of life is this, that people in our country will be interested in finding out who did it rather than why did that happen. Okay, and that is where there is a need of a sea change attitude that is needed, which we are talking at the moment of time. I don't think we are really very close to it. But I suppose such kinds of talks and deliberations and probably interdisciplinary discussions probably will lead some kind of path or some kind of way, and we come closer to things which are not absurd, but which ultimately prove or which ultimately lead or give the healthcare. So in legal parlance, we always talk right care and Article 21 and all that. But in realistic sense, if you really want to give it, then we need to really proceed ahead in leaps and bounds to achieve that kind.
I think you hit the nail of the coffin, Nikhil. I think that's very true. Instead of why it happened, they'll say who did. That's. I think that takes us to Radhika back again because she was going to talk about the feedback as a last slide. Sorry, we cut you off. Radhika, back to you to.
Yeah. So I will, in fact, just link it to what Dr. Datar was saying. Okay. Uh, Implementation is a huge challenge in this country. Okay. But let us understand that when we had a celebrity being hospitalized for COVID, that news was gathering more importance than active COVID numbers for the entire 15 days in this country. Okay. It's a very shameful fact. I'm willing to admit that. But a little bit on that law, and I'm sure Dr. Datar is aware for everybody else. Doctor is the only profession in this country which is allowed a defense of error of judgment. Negligence for everybody else is negligence, whether intended or not. But Doctor Consumer Protection Act has given a clear cut defense of error of judgment. The classic example you gave, Doctor, let me tell you that there was a very similar case, I'm sure all of you are aware, was on notes, a difference in notes. Baby died was read as baby died. Unfortunately, the baby died much later, and it was claimed the case went on for 17 years up to Supreme Court. It was claimed that the baby was born dead. Now, I'm sure you all are mother and child doctors and are aware what happens if baby died is written as read as baby died, and the baby dies after 4 hours. So, what I'm trying to say is that error of judgment is a defense least used, understood. I understand the police investigation agency does not understand, but courts do understand. Implementation is a challenge, but I think coming back to that, transparency, I understand when we talk about fear around it. Uh, the it was the same doctor who was caught because of this baby died and baby died who asked me, why should I be transparent when you don't understand what goes in medicine? Medicine is not an absolute science. I understand. But there is another category of people when we're talking about financial management who also understand this, still want transparency, your funds, is your investors. So if you are able to tweak it, to understand it from making transparency a tool of strength rather than exposure, I think a review and feedback mechanism is all about that. If that can be built in-house in your process, it's a fantastic growth model that will bring in a lot of trust, a lot of faith in the hospital institute that works on it.
Thank you.
Thank you, Doctor.
Kishore, just have one question. Can I ask?
Yeah, go for it. You are the.
Srikanth and Radhika, it was fantastic to listen to both of you. The model is pre-COVID model. Now, what do you say about the COVID time? Depicts very well pre-COVID. So I think most of the hospitals understand that. Now, during COVID, and I'm not sure what happens post-COVID, how does the revenue and finances make an impact?
Srikanth, do you want to take a go at it? We've been advising in the last 5 or 6 months extensively on this. Do you want to start and I could then?
It also, I mean, you were at it and we were together at it. So why don't you just lead it? No problem. I'll jump in wherever.
Okay. So, how our finances and expenses should be looked during the COVID? Let me tell you very frankly, there is no history in my life or in my forefathers' life that faced something like this. Whatever we have learned from March 15th on this, right?
Yeah.
What has been our learning, at least my learning of all of this is, leave aside the fact that I spoke about ad hoc regulation. Suddenly they said, no, you have to pay full salaries. Then they came back and said, no, you can do this. Now they've come back with a regulation that says you let resources work for 7 days, give 7 days break, then give 7 days this. Impacts your expense, right? Managing the whole thing. They regulated pricing. They regulated not pricing just on COVID. They regulated pricing on everything that came, that hospitals worked on. Can there be an answer to overcome the regulation? There cannot be. Can there be an answer to work parallel to the regulation? I think there can be an answer to work parallel to the regulation, right? And that answer does not lie in the way that, let's hide from the regulation. Let us not show so many beds. Let's not show so many resources. Let us not show we have an intensive transport. All sorts of solutions that came to. The answer lies in twofold. One thing is be a part of that policy making, and even if you are not accepted, find a way to be a part of that policy and a regulation making manner, even if it's they're regulated by the executive and legislative or mostly the politicians at a state level. Try to be vociferous and speak about the fact that it is not helping what the way regulations are coming out. That's number one. Secondly, understand that pandemic is a strange and out of the world and kind of a time. Need not necessarily your math come to 2 plus 2 22 during this time. But if you're able to sustain and survive then your growth is guaranteed in the future. Put care, put service before for a while, and then invest in your resources. It's okay. You're doing it out of pocket, there's no problem. But invest in your resources, invest in providing that care, investing, making sure that we are out of this pandemic situation faster and earlier that the world faces. This investment will is directly proportionate to your future growth and profitability. Srikanth, do you want to just add to that? I mean, this is my
You precisely answered that, I think. I mean, Dr. Prakash, please, if you got your answer.
Okay, thank you. Kishore, do you have any other questions from other people who have participated?
No, I think there's one comment which everybody liked about Radhika's comment that healthcare is perceived to be not for profit. That opening statement, and they were a lot of people are asking why only healthcare is perceived to be not for profit. Why not a hotel? There are lots of people starving and dying. Malnutrition accounts for 40% of the deaths in India. Why not all the hotels are perceived to be charitable? Why only healthcare? I don't know whether you have an answer, Radhika, but that's...
Well, no answer, but I can tell you that an effort needs to be made to accept healthcare as a profit-making institution. I am very vocal about it. I tell you that if people who run the healthcare do not make profit, never a good healthcare service is going to be to our citizens. Never. And if we are able to, and I say this at a much larger level, that in my life, if I'm able to bring about a change of perception to that, I think that's something that we need to work towards. Effective management of your institute from the beginning, understanding that there is dependencies on other specialized services right at the beginning, tweaking the models, keeping all of that we spoke in mind, goes a long way in creating that kind of a perception change in the society. Eventually, if I'm a happy patient, I mean, there is a thing like a happy patient, but if I've got good service, I don't mind paying for it. I don't mind if somebody else makes money out of it. If we are able to create that mechanism, that perception change, I think, Doc, that is the way to go for healthcare.
I think there are lots of appreciation and comments on Srikanth's model of case study. And a lot of people they had not realized that that was the case in most nursing homes. There were not questions, but everybody has appreciated that case study.
Thank you.
And I think Radhika's point that ad hoc regulated health that most of us have not realized. So there are lots of people saying that that is what exactly is leading to reactive decisions by the doctors rather than proactive decisions. So there's always ad hoc legislation being imposed on us. Then we react to that. And that's why we are struggling most of the time. Say, for example, recently that KPME legislation in Karnataka. I don't know whether you're familiar because you're in Mumbai, Radhika, but we had been fighting. So legislations are imposed on us and then we fight rather than representing proactively. So that was a good lesson. I think we have to take that lesson and we have to start becoming more MLAs rather than lawyers. So
Yeah.
I don't have any
Kishore.
other questions here. Dinakar, you have any? Prakash?
Kishore, we have a few panelists, right? So I would like to request all the panelists to, put their thoughts.
Yeah, definitely go for it.
Dr. Edmund Paul, would like to contribute something? Hello?
Dr. Edmund, you may have to unmute.
What I heard from this is that the discussion is that we are they always point out the any project we are doing, any product we are buying, we need to look at the ROI. It's a very, very important point. Many of the hospitals never do that. Even corporate hospital, because of the pressure from the doctors and all, many times without looking ROI, people go and buy the products, add a new wing. The expenditure is not calculated, or that expenditure is normally do with or the investment they do without any ROI calculation or business plan, and finally land up in trouble. Many of the even small hospitals getting sold within 2 to 3 years time because they are not adherent to this kind of business plan and ROI. That's a very good important what the finance the finance is very much clear about that, and those people are running the business also need to be clear about it. Always the strength of the organization, the financial strength of the organization is definitely how we run this business along with the finance. So I appreciate that idea.
Thank you.
Do you have Dr. Nalan?
Yes, sir. Sir, can you hear me?
Yeah, we can hear you. Go ahead.
I really appreciate both the speakers for today. My question is open to both of them. I think Radhika would be in a better position to answer this. Off late, I have noticed in my institution, it's a 550-bed multi-speciality hospital. As you mentioned, these doctors' notes are hard to understand by laymen, and these insurance companies, for reasons best not known to them, deny this insurance, and the customer, the patient, ends up suing them. Agreed. But they make the hospital a party. They implicate the hospital also, and one or some pretext. The insurance company also is party to this. They want the doctor to come and testify about the notes, all these things. My question is, Radhika, like the bill is 1.5 lakhs, and we have end up paying 40,000 or more to the advocate, and still there is no mistake on the part of the doctor. At the end of the judgment, agreed, if we are wrong, okay, but if there is no fault on the part of doctor, is there any way to recover this 40,000 from the patient or from the insurance company? I mean, I'm just out of ignorance, I'm asking this. Can you please throw some light on this?
I appreciate your question. Let me tell you that if your question is about who you should recover it from, you should just take a good insurance at an entity level, which is called an error and omission, a legal expense indemnity insurance, which we all are aware of. Because the fact of Healthcare Institute life history is there is going to be litigation. It is not necessary that you are going to be responsible, or even if there is a mistake at your end, but you are going to have an expense. I think it is very important that the institute is protected from a very, very good insurance policy, in indemnity policy. I know it is very common amongst doctors and surgeons, but it is not common at an institute level to take this. But understand the fact that
We lost power, so she might.
I think we lost power there.
She lost power there, yeah.
Okay, sir, we can keep this question for another day.
Yeah, so the answer
Sorry.
is insurance. Yeah.
Okay, we are back.
Yeah. Yeah, I'm sorry. Internet, I mean, I can't help it. But the answer lies in don't just invest in protecting your surgeons and doctors by taking in indemnity insurance. Take it at an institute level. It is a given that you will need, if I can be very brash about it, you will need lawyers, whether as a prevention, whether it is a protection. And therefore, create a good insurance policy flexible mechanism to back your legal expenditure that can come during. It is not necessary you are in the wrong that you have to spend. It is not necessary that you are even responsible 1% for that action. But the service is such that is exposed to this kind of expenses. It is best that you cover it through insurance. Does that answer your question, doctor?
We do have one, madam, but thing is, our legal officer is telling that covers only indemnity, negligence. This is not an allegation of negligence. It is of effective practice, trade practice. So on one protection or the other, it is being turned down.
Medical expenses is now available in the country to take a cover without there being a case of negligence.
Okay, thank you. Thank you.
So do we have Vinu Sanai to ask any questions? Lakshman? Anybody else would like to? Dr. Prashant?
Yes, sir. I think, yeah, there is some question. One second. I think most of the questions are already. Amit has raised hands. Amit, kindly unmute and ask.
Yeah, hello. Excellent lectures. I would just like to ask, what are the aims of financial audit of a hospital? Because most of the fight is between the doctor and the hospital. Hospital says the doctor should get less payment, and the doctor says it was my patient, I brought it to your hospital. The main bulk of money should go to me. And so that is another fight which is going on between the doctor and the hospital level. And how do you tackle it? In corporate, system is different, but in the middle level hospital, this is another fight which is going on. Surgeon, they would charge 2 lakh package, and then they would say hospital, aap apna OT charge batao, ye batao. 20,000 hospital ko they will take 1.8 lakhs for a say 1 hour, 2 hour surgery, say a hip replacement, anything. So how do you tackle that? The balancing act between appeasing the doctor as well, if you are a hospital owner, and retaining him, say a good doctor versus hospital has a huge expenditure of their own, and they have to maintain that as well. So how do you strike that balance?
Well, see, this is a very commercial or a business question, very interesting one. That. See, when we talk about pricing your services, often, of course, the majority of the services cost goes to the doctor who's delivering the service. We understand that, we all understand that. But once you are an institution, you need to have a very robust cost capturing mechanism and cost allocation mechanism. See, it's not necessary that because you are not performing this activity by yourself in that location, the price should not become a compromise for you because some other doctor is using your OT to perform an outside doctor and you're lending the services. So here what you're lending is a real estate space and infrastructure space. So you need to know what is your doctor's cost, what is your infrastructure cost, and how do you allocate it. So if you work a good, if you will also have to see what is your percentage of such OT usage during the year. Arrive at a more, scientific way of allocating your cost so that you are able to recover your margins had you done this exercise yourself. Okay. One, if you had performed it yourself, what would have been your margins? Then you are lending it to somebody. What is that margin that you are going to make? It can't be there. It can't be just a cost plus small percentage. Then you also have to see what portion of the profit you have led on by lending that space to somebody else. So there has to be a profit element arrived at in the costing, and that has to be split. So which means you are typically, when you are doing this, you are not giving away 80%. You may be giving away only 60% of the total billing. So that way you are able to manage it better. And also, of course, it is about your fixed cost recovery, then your marginal costing system all comes into play there. Sometimes you will let these OTs available only on a weekend when you are not performing. Then whatever comes is actually going towards the, taking care of your fixed costs. So you'll have to see how you are going to price it. If it's going to be like, say, 40% of your OT is used for outsourcing work, then you need to have a different pricing model altogether. You can't then have it like cost plus 1% or 10%. You should, and again, what is cost? You will have to define it correctly. You need to know what overheads will get added into that cost to arrive at your cost. Then, of course, there is always the competitor who is also giving that space to the other doctor. So your infrastructure, quality of infrastructure, equipment that you have versus what the others, you should have an ear on what the market is offering in the neighborhood, and therefore what convenience you are creating to the infrastructure there. That would be the methods that you can adopt to arrive at a very proper structure in place. So a little bit of deep diving would be required. It's a very case-to-case, hospital-to-hospital advice, but this is the common principles on which it will get structured. I don't.
Do I have a time for another question? I have one question related to finance as well only. And that is like, if you have multiple partners in a project, say 6 of them come together and make a hospital and run it. 3 of them are very busy and quite, busy with their patients the whole day. Now 3, they are responsible for most of the profit of the hospital as well. Other 3 are maybe young and just, they are into it, or if they are old, then they are not very successful, but they have contributed equal amount of money initially at the time of build-up. Now, because they have time, because they don't have patience, they are making all the decisions, and all their decision making are, maybe just to favor by equal partners, and the money go here, there. How do you give the incentive to the doctors who are actually giving the entire day in the hospital looking after the patient, so that some share extra other than what they work from hospital kitty mein jo aa raha hai na, how do you give incentive from that to somebody who is seeing more patients? That is the simple one line question I have.
Okay. So there are multiple ways to do this. One, it has to be controlled at various levels. One, at the arrangement level itself, in the sense that when you have contractual arrangements between the doctors, you could define them. But more precisely, when you're talking about how you want to restructure or work around it, is create what is called P&L concept, what we call it, as each doctor becomes a P&L owner, a profit element owner. He becomes the responsibility for generating his income and his expenses. So what happens is, then you create what is called direct cost versus indirect cost. So the indirect cost becomes your overhead allocations. You create a bucket for that. Let's say we do a 60-40 ratio or whatever it is. You will have to arrive at the costing structures. Arrive at all your common costs that will be allocated across all the facilities that you have, according to the departments that they are responsible for. Irrespective of work done, that cost gets loaded onto that particular department. So which means if the doctor is spending time sitting in an air-conditioned room, not doing so much of billing, he is also loaded with that cost. Now, for him to earn that cost becomes his responsibility. So he has a P&L to run behind to earn that for the organization. So either he productively spends time to billable hours, or he can sit back and not take any money out of it. And the doctor who is creating that P&L work, profit element, he obviously has his positive outcome because he has his overheads are very low compared to his earnings. So naturally he has a larger gap. So he definitely gets a larger percentage to take home. So technically this whole structure can be put in a very capitalistic model. The model that you are currently facing is because it's a socialistic model where you are saying everybody is equal. So when you start seeing everybody as equal, it's a socialistic model. Whether you work or don't work, you get your salary. Whether you don't,
people go to 3 different hospitals की इस हॉस्पिटल में तो हॉस्पिटल ज्यादा चार्ज कर रहा है, इसमें पैनल के अंदर मुझे कम पैसा मिल रहा है, मैं दूसरे हॉस्पिटल में जाके ऑपरेट कर लूं। और जब शेयर का टाइम है हम बराबर के पार्टनर हैं, भाई प्रॉफिट 10 लाख है तो सबको 2-2 लाख सबको मिलने चाहिए।
Correct. So you got to restructure your arrangement. So what you must do is move it from a socialistic model to a capitalistic model and link it to the performance. Trust me, everybody is going to be happy and everybody is going to get that share due to them. And it is doable model.
Okay, thank you.
Srikanth, if I may just add one point there, and it's fantastic when Srikanth says move it from a socialistic to a capitalist model. Also remember, one is a concept of profit, the other is a concept of value. Value is built over time. Somebody who is not necessarily adding to your profit margin today is probably adding to your value margin eventually, right? Find a way to build the mapping of your profit as well as your value. Certain people in this industry bring brand, bring recognition, bring research, bring development. So they may not add to your margins right there, but they add to the value that your organization builds over a period of time. So profit equals value, not necessarily in the short and in the midterm and the long. So map your profit. Fantastic point, way Srikanth explained. Create a mechanism equally to map your value mechanism into the organization, coming in from the people who are the founders or who are the promoters of that organization. I just wanted to add because I thought that was also a very, very critical aspect of when you look at.
Because so what happens, doctor, is ownership structure, your operating structure will not always coincide with each other. They have to be seen differently. Yeah, ownership structure is mostly to do with your entitlement because you contributed into the capital of the entity, whereas operating structure need not necessarily mean that it sleeps with the ownership structure. It will never do that. Reality, operations, if it coincides, it can only happen when ownership and operations are the same people, which means it's a family-run organization where nobody else is involved. Husband, wife, both are doctors, or children, everybody is doctor in the family are taking care of it. Then they will overlap the ownership structure and the operating structure very beautifully. But when there are professionals getting together, you don't mix these two. Keep them separate. Treat them well. Both will be happy because shareholders have to get their return. But what will get their return after paying off whatever is due to the operational achievers, which includes the contributions made by specific doctors who have worked 20 hours a day. They will have to be paid off first. Whatever is left is what will be divided by the owners. So which means if they are going to harp on, anchor the ownership with the operational efficiencies, there will be an imbalance. So bring that capitalism with the right thing, like said, value creation, you set aside that and focus on business with, because sometimes what happens, some of those doctors may be very connected elsewhere to get you connections to open 10 other hospitals and grow it faster. Maybe you need them for something else. Their specialty lies there. They will get their dues when the ownership decisions are made. Operational, they will not get their profits on a day-to-day basis. So we can still live with each other and work with each other happily. That's the right way to think.
That answers it.
Okay. So I think it's almost 7:30. I don't think so there's any further questions. Prashant?
Yes, sir. If any of the attendees have any questions, they can unmute and ask. This is one, yeah. I think.
No one, right?
Yeah. All right.
Thank you. Srikanth and Radhika, it was fantastic, to listen to both of you. So the evening was quite useful to a lot of us, and we look forward to, probably hear more, on a personal basis as well as on some of these webinars. Kishore, any last few words, Prashant?
I know how busy Srikanth and Radhika been, and thank you very much for sparing your time and the evening with us. Really appreciate. Thank you.
Thank you, Doctor, for giving us the opportunity. It was a pleasure.
Say whether it was fruitful. I leave it for the audience to decide that, but I hope it was at least helpful. Thank you very much.